Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I'm going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there, take a look, see what's going on today. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com. I dive deeper into all these different topics, subjects, looking for investment opportunities and sharing those opportunities with everyone in the community. We do have a special going on. Special is the coupon code where you can get savings on both the monthly and yearly memberships if you'd like to sign up. So we got some ratios. I started off with some ratios. There wasn't a ton of stuff being shared on Twitter that I thought was that interesting. So I was like, you know what? I'll just go through what I think could be the most interesting things. I put oil ratios up here. I know oil is out of favor. It doesn't mean that oil is going to necessarily rocket higher in the very short term, but it gives us an idea of the valuations of where we're at. So I did an oil to gold ratio, oil to Dow, and oil to platinum. And if you were to look at these ratios, historically, oil's expensive at the top, cheap on the bottom. And we're at ridiculously low areas. Now, I'm not stating that we're going to go up immediately. I'm not stating that. What I'm saying is it's very cheap. We should be looking at opportunities in the sector, but I'm not stating that oil's just going to fly higher. We haven't broken out. We haven't done any of that yet. So yeah, we could still go lower, possible, but we're at a very low level. So if you look across, we are currently trading cheaper than any time in history outside of 2020. That is it. Now, someone can say, well, it could get cheaper. I agree, it could get cheaper. But think of it this way. How much money do you think you could make if you're buying oil at the second cheapest time in history against gold? Do you think that the probability of making money over a 5 or 10 year period is good or bad? And why do you think that's the case? So I would say it would be a very good opportunity to make money over the next 5 to 10 years, based off of where this ratio is located in relationship to gold. Um, I'm not stating in the short term that it can't get cheaper, as gold is in a big, powerful bull market. Crude oil is still lagging behind. We haven't broken out of any of its patterns yet. And if it does, where crude oil still goes sideways, gold goes up, the ratio falls to the downside some, that just makes the opportunity better, even better. So that's what I've got there: slingshot one, slingshot two in the making. This is zoomed in on the right hand side. You can see the three hump consolidation, and we've fallen to the downside, and there could still be some gyrations in the corner over here. So there could still be that going on. We've got crude oil divided by Dow Jones Industrial. We have a falling wedge that had a false breakdown in 2020. That was the C19 event. False breakdown, slingshot higher. Now we're coming and we're at the tip of this other falling wedge there. Of course, I didn't go to the tip of that one. Could we get another false breakdown or some sort of event? Maybe. Maybe we could. Where we get a false breakdown in crude oil and then we slingshot to the upside out in the future. Still a possibility. And then we look over to crude oil versus platinum. I know, why am I doing that? I took the fractal here and overlaid it on top. You can see, let's do this here. Let's do crude oil divided by platinum. And what I did is I took this fractal there, you can see it. I moved it over, which is the arrow, and expanded it to kind of overlay and see what this looks like. And you can see that we squeezed up for platinum, crude oil versus platinum, and platinum broke out against crude oil to the downside. If you look at history, you're at a very cheap ratio down here at about 0.03. So could platinum outperform crude oil for a little bit in the short term. It could. And that's what occurred in 2019, 2020. So 29 or 2019, yeah, or 2018, I should say. 2018, we had this downward move, almost like a nice little consolidation uh, pattern here. We'll call it like that. So we had a nice little break out of that and then came right back up and fired off. I think we have a false breakdown again here. Very similar to 2020. I don't know if this is the absolute bottom or not, but somewhere in this range there is probably we'll get a complete bottom against platinum versus crude oil or crude oil versus platinum. Coming back. Platinum to gold, silver, and palladium ratios. Why am I focusing on platinum? Well, I think it's real cheap. That's why. Somebody wanted me to do a couple of these. I was like, yeah, I'll share it to everybody, I guess. We've got the buy gold zone up here where platinum's expensive, and we've got platinum cheap at the bottom. We've been in this big kind of declining channel. It's very cheap right now. We broke out. Of course, I don't have that. We broke out of this downtrend here to the upside, and we've been consolidating right underneath resistance, that top resistance line channel. And I might have another picture of that zoomed in. This has been heading higher. Platinum's been outperforming palladium. So this is a platinum bull market, a palladium bull market, and now we're in a platinum bull market. So that's good for platinum outperforming palladium. We've also seen that that happened or occurred at a complete bottom of 2001. So this upcycle are bull markets in commodities. Platinum outperforms. This is platinum versus silver, and I know we've got a lot of silver bulls. I'm one of them. Silver looks fantastic. We've got a big cup and handle looking like it's going to break to the upside. There's a lot of other ratios that I look at where the silver equities look pretty solid. But when I look at this, this is trying to break out of this upper trend line here. It's starting to break out. So we could see platinum outperform silver here. Now, what if silver moons? What does that mean for platinum? Maybe platinum moons more. I don't know. Um, but it looks pretty good here for a potential outperformance, and we're at a really cheap ratio for platinum in relationship to silver. So, what's my takeaway here? Platinum's cheap against all of the metals. It is progressing and outperforming against palladium, and it has yet to have a large outperformance against gold. Silver, it's broken out, it's consolidating, and we can look at it through here too. And we're doing a retest on top of potential support here for the platinum to silver ratio. So that's underway, and I do think we could see it's possible an outperformance of platinum out in the future after this retest is done. So I think platinum looks pretty good, but I've thought that for a while. Tavi says it's interesting to see some people claim inflation is slowing. The equal weighted commodities index is up 12% in the past year. That's real world inflation. Meanwhile, US money supply just hit a new high and the dollar is weakening sharply against other currencies, including emerging markets. Inflation is far from contained in his view. Well, it's not they're not containing inflation. They're creating it because they have to get out of the debt. They're stuck with their back against the wall with how much debt they have. So they have to inflate their way out of it. So a byproduct of all of that money printing is emerging markets going up, the weakening of the dollar, and commodities going up. Now, commodities don't go up, it's the dollar going down, and then money leaving dollar-based assets. So it shifts to emerging markets, it shifts to commodities and precious metals. So yeah, I agree. So Jim Bianco says this is not fixed. So what we're looking at here, this is the median household income necessary to purchase the median priced home for sale in the U.S. $124,000 is now 57% higher than the current median household income. That's what they're saying. Someone is saying there's a 57% affordability gap, income needed to buy versus actual. Jim says this is not fixed by cutting mortgage rates 100 or 200 basis points, if that is even possible, via Fed rate cuts. It's fixed with lower home prices. IOW, trade a home affordability crisis for a financial crisis. Then Smart Real Estate Bets steps in, basically stating that they are wrong. It says you made the mistake of assuming that post was factually accurate. It was not. It's not even close, unless you think the US housing market was born in 2008. It also needs a lot of context. P.S. When in doubt, do the math yourself. So this is the actual math, and this is what eludes everyone on Twitter, apparently. All the housing bubble boys and all on the affordability crap. I'm not stating that house prices are going to go up. So that's not what I'm stating. What I am stating is, and a key component is listening to what I say with you have to listen to what I say, not what you imply in your head. So if I say that something is factually incorrect, that does not put me in a bull or a bear. If I say that what some person said is factually incorrect, and let's say they're a Democrat, that doesn't mean I'm a Republican. What people do is they draw to conclusions so rapidly, and that is something that is absolutely annoying as crap. So don't go to an assumption that I'm 100% a real estate bull. That's not what I'm stating. What I am stating here is that there's a lot of information on Twitter and in these charts, and I don't know why it is the fact, but I don't think that uh, whoever is creating a lot of these charts, I don't know if they've got a math or statistics background. I don't know if they understand what's going on. They're just throwing this crap out all over the place. So if you do the math, here's the math. The characterization is egregiously false and on multiple fronts. Let me count the ways. First, the median price for all houses sold in quarter two of 2025 was 410,800, and Friday's 30-year fixed rate was 6.57%. With 20% down, this is the monthly payment. So 410 is what we have for a price of the median house. This is our mortgage rate. We do the math with 20% down, it's a payment of $2,092. You don't need $124,000 to afford this. This is what the payment would be, a little over $2,000. So it's not that this, I mean, I don't know what this means here. Qualified, it says income needed for annual homeownership cost to equal no more than 30% of annual income. So then if it's no more than 30% and you have a 2,000, this is how you do the math. If it's 2,092 divided by 0.3, that means you need 6,973 times 12, an income of 83,680. That's what the income is needed to afford that mortgage at a 30% of income. That's the math. So that's what I wanted to bring up there. Looks like I accidentally hit a button there. So be careful what you're listening to, be careful what you're reading, be careful of taking these numbers at face value. Artificial intelligence will also screw this up because what it does is it searches for articles that give you false information. If it yanks false information, which it believes to be true, then you gotta, I've been using a lot of artificial intelligence. It's really good and it can be absolutely deadly in the hands of people who are very capable and know what they are doing. If you put it in the hands of people who do not know what they are doing, garbage in, garbage out, I think it will be actually worse. But, I mean, I hate to say it, but if you don't have the brain on you to figure out anyway, I don't think it's going to matter. I don't think artificial intelligence is going to enhance anyone who can't think already. But for those who can think already and they're pretty good at thinking and getting things through, you can use artificial intelligence to your advantage because really what it is it cuts down, it's basically you can run it for calculations and you can use it very well for searching things. So you can search things pretty quickly and you can use calculations as long as you input the correct information. If you ask it what I would consider to be open and broad questions, I think you're going to get answers back that aren't any way meaningful. You have to be calculated, precise, direct, and then you need it to calculate some sort of thing that you want. Coming down, Eric Yoon says every time something fundamentally positive happens to gold, SGE, arbitrage, Fed paper on gold revaluation, Trump tariffs on Swiss 1 kilogram, 100-ounce bars, all the no-name burner accounts jump out to tell the plebs that these events are nothing burgers and should be ignored. Over time, the USD price of gold marches up, and the plebs who listen to these no-name burner accounts miss every chance to buy cheaper physical gold. You know, I don't I don't look at any of this like this news. It's all garbage, guys. It's complete and utter garbage. What is the root of the movements of gold? I mean, that's really what you want to get down to, right? What moves gold? It's a weaker dollar, right? A weaker dollar. And what are some indications that a weaker dollar is has fundamentally changed the market? Like what is a big paradigm shift? It's interest rates bottoming in 2020 and 2021. Everything else is all tertiary effects of that main movement. So everybody wants these short-term moves. This is all garbage. It's all news. Like it's just all secondary events to the main event. The main event is inflation and interest rates and people getting out of bonds. That is the main event. So the main event is that. The second main event that's coming is people getting out of stocks. So ultimately, you're forced into very few asset classes that work under the market condition that's coming. All of this other stuff, I mean, it's just diarrhea on a wall. I mean, it's just crap thrown up against the wall that people are trying to explain price movements. That's all it is. So the closer you get to the drivers, the fundamental drivers of market movements, the better you will be. So if someone said, Andy, why did you invest a whole bunch in 2018, 19, and 2020 and 2021 in all these different precious metals? Why? Was it geopolitical conflict? Was it war? Was it this? All these people make up all this BS of why these prices are going up. I would say no. It has everything to do with interest rates. And once people leave the bond market, where are they going to put their money? And then once interest rates go above about 4.5%, 5%, when it goes above that and keeps going higher, where are people going to put money if they're not putting it in bonds and then the stock market starts to go down? What are they going to do? What are they forced into? Does this have anything to do with that movement that I just described? No. What this is, these are all reactions to what's coming. Trump is reacting by putting tariffs on Swiss. Fed paper on gold revaluation, that's a reaction to the fundamental movement. That's not a driver. The arbitrage that exists because of the fundamental factor that is coming and impacting its movement or its money flows and movements on everything. These are all reactions. They're not the main drivers. Just wait until the stock market stops working. So let's just run through this real quick, a moment through time, all right? We came to the bottom of the market in 2020 with interest rates. the stock market flew as they printed money and kept interest rates low. That is the exact time frame that stocks do well under. But if you look at it from a long-term perspective, I don't want to put my money in something that's overvalued. So I chose to put it in what's undervalued and had the largest discrepancy in valuation in the history of mankind looking backwards of, say, oil to gold, oil to Dow Jones, some of these other metals like platinum and silver, the just the outright ratios against all of the other asset classes were ridiculous. Basically, I was picking up pennies for future dollars. Like their valuations were pennies on the dollar for what I could buy. As interest rates went up, what that means is that money was leaving the bond market. Money was exiting the bond market, but it has choices to go into in a market condition of low inflation and low interest rates. They just printed all that money. So a lot of money made its way into the stock market and into commodities and into precious metals. As interest rates and as inflation goes up, so inflation goes up because of the money printing, interest rates follow. They get into this debt problem because we have so much debt and more money needs to be created, more inflation into the system. It starts to build on itself, right? But you still have options. You've got stocks that still work at this current time because the interest rates haven't really breached the 4.5% level yet, or 5%, somewhere in that range. Commodities have worked quite well. And yes, we've consolidated for a year in some areas. And precious metals have done fantastic from 2020 bond. As interest rates continue to go higher, there's going to be less and less choices. Stocks, when it rolls over, it's not going to go into the bond market with interest rates going up. And stocks rolling over means that you just lost an asset class where money's going to go into. So it's going to get funneled into less and less things that are working over time. And that's where I think you're going to get a gigantic bull market in precious metals and a bull market in commodities because everything else is not going to work. It's gonna be crappy. Dan says another positive oil view in 2026. Add EOG, which is a company, to the list who sees a balanced oil market in 6 months or so, which points to OPEC's strength in 2026. This is the Q2 call on the Q&A session. The CEO of the company EOG says, but ultimately, once we get through the next quarter or two, maybe seasonally demand weakness in Q1, we actually find ourselves looking at a potentially balanced market going forward. And what we see is less non-OPEC supply coming on in the next couple of years than what we've seen. And so it really sets us up. That's why I said in the opening remarks that we start to see in 2026, you arrive at a spot where pricing is likely more driven by fundamentals without as much spare capacity offline, and a market in general that looks more balanced in 26 than it does today. So that's the insider's opinion from EOG on their conference call there. Of course, I got coming down. AI is one of the biggest threats to your income stability, but also one of the biggest opportunities. I think I read that last time there, so that's where we're going to end it. Is right there. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. That's all I've got for today. We've got a question and answer session that we did yesterday, so everything's been loaded to the website if you'd like to see that. It's all uploaded, and that's all I've got for today. So we'll catch you next time. See you guys.